Hey everyone. So I was recently searching for the best place to hold my emergency fund money in Canada, and after going through many options, I decided I would be happiest with EQ Bank. It's an online only bank with currently a 2% interest rate on high interest savings account, and it has no fees for anything. After using it for a while, I liked the product enough even to refer it to many of my family and friends. And of course, about 1 week after I signed up the last member of my family, they decided to add in a referral bonus. Realizing that the quality of this bank will probably attract quite a few customers in the coming years, I decided to look into the company as an investment for my portfolio. So I did a bit of an analysis, but I also wanted to hear what other people thought about EQB as an investment. However, searching the web, I couldn't really find anybody who covered this as an investment topic. So I decided to make one myself with the hopes of bringing this investment idea to other people's attention, along with hopefully getting some other people's inputs and ideas about this investment. Now, before I get into my own analysis, please remember that you're listening to a random guy on the internet who may or may not actually know what he's talking about when it comes to finance. So I would recommend actually clicking away from this video right now and getting advice from a real financial professional. Fantastic. So now that my audience consists of people who don't listen to random people on the internet, let's get into the analysis.
So I'm going to break this analysis down into 3 steps. Since the reason I became interested in the company in the first place was because as a consumer, I really liked one of the products that they were offering. So the first thing that I'm going to do is actually give a bit of a review of the product that drew me into actually looking into the company in the first place. After that, I'm going to open up the most recent quarterly report and do some fundamental analysis and look at their financials and see what kind of state the company is in right now. After that, I'll summarize the main points that I talked about and try to give my opinion on whether I think this would be a good investment in the long run or not. So obviously I've made it quite clear that I really like EQ Bank as a customer, but just because a company has a really good product doesn't mean they're necessarily a good investment. So I'm going to try to be as unbiased as possible when going through everything, and I'm going to try to give you as transparent of a view into the company as possible so you can make an informed decision of whether you'd think it would be a good investment or not. So I just logged into my account, and immediately the user interface is actually quite intuitive. They have all the main options right in front of you. It's a very simple layout. There's not a lot of things you can do, but the things you can do are the important things. Within EQ Bank, you can have up to 5 different high interest savings accounts, and there's no difference between any of these. They all provide, currently the rate is 2%. One of the things I really like, and I haven't seen any other of the big banks do this at least, you're able to transfer money between different people who have EQ Bank accounts extremely easily. All you have to do is set up their email one time, and then anytime going forward, you can send whatever amount of money to them. It's even easier than sending an e-transfer, and it's pretty much immediate, which is pretty cool. You're also really easily able to buy GICs anywhere between 3 months and 10 years. Right now, of course, the interest rates are pretty low, but you can buy GICs anywhere from $100 to $100,000, I believe it is. And one of the really appealing features to this is there are no fees involved in this. There's no lower limit to how much money you can have in here. There's no e-transfer fees. There's no fees to buy GICs, no money transfer fees, anything like that. You just get their current interest rate. And that's pretty much all it is. They also added a feature recently, which I haven't used yet, but you can set up a joint account now too. So if you have a partner that you want to share a bank account with, you can do that through EQ Bank as of a couple weeks ago of filming this video. So those are the things that I really like about EQ Bank. There are a few things that have annoyed me a little bit, such as when you move between 2 different pages, there's always this pink loading circle that shows up, and sometimes the loading times can be really, really long, like anywhere between like 30 seconds and a couple minutes, and usually refreshing the page fixes that, but it's nothing to do with my internet. I've tested that. It's something to do on EQ Bank's end. I haven't experienced that within the past week or so, but that has been a problem for me in the past. Another thing that's a little bit annoying is that it'll actually log you out for inactivity even when you are active. I think there's just like a timer that starts when you log in. It might be like 20 or 30 minutes. Whether you're using the website or not, after the time is up on that timer, it'll just log you out for inactivity. Even if you're doing stuff, which is it's a little bit frustrating, but I mean, it's a minor inconvenience considering how good the product actually is. And of course, since it's an online only bank, they don't have any physical branches, and they're not partnered with any other cash withdrawal companies. You won't be able to directly withdraw cash from this account. You'd have to transfer it to another bank account that allows you to do that before you're able to physically access the cash. Now, nowadays, it's not quite as important, so people will be more comfortable with having an online-only account more and more going into the future, I think. But for some people, that's just really not what they want, so that's important to keep in mind. So overall, I think EQ Bank as a deposit-taking business is probably going to do pretty well in the future. They're doing a pretty good job marketing, and they offer a really good product. And I think as people start using it, they'll probably start recommending it to other people like I have, and I wouldn't be surprised if EQ Bank becomes a lot more popular over the coming years, especially if they fix the little annoyances they have. Now, of course, as of right now, EQ Bank is only a pretty small part of Equitable Group as a whole, and what this video is for is really analyzing the entire EQB company. So let's get into that now. So how I'm going to do this is I'm just going to jump right into the income statement and go through the financial state of the company and then slowly kind of unpack what the business is as it becomes relevant while we're looking through the financials. So jumping into their most recent income statement, which includes up to the point of March 31st, 2020, the first thing I noticed, of course, was their earnings were down quite significantly compared to this time last year, and even more so against last quarter. However, looking further, revenues have actually risen in every category compared to the same time last year, and I think they've dropped a little bit since last quarter, but only by a very small percent. Looking a little bit deeper into the income statement, we can see that the large drop in earnings is really because they increased their provisions for credit losses quite substantially since last year. And that makes sense since we're kind of going into a recessionary environment. The bank is really just bracing itself for a higher likelihood of people defaulting on their loans. So although earnings are down, at least it's because the bank is stashing away some of their extra profits in the case that they have a higher default rate on their loans, and they're kind of covering themselves so they have a bit of a cushion to fall on. As an investor, it's really not pleasant to see profits go down so heavily, but at least it's clearly to help the bank stay afloat during economic uncertainty. And it's not because revenues are dropping. And I'll talk about revenues a little bit more in a couple of minutes. But if you look at any of the other major banks, like TD, Scotiabank, Royal Bank, the exact same thing happened with all of them. They dramatically increased their provision for credit losses in the event that people start defaulting on their loans at a very high rate. Now, I've said that revenues haven't dropped on their income statement. However, I should mention that they did touch on this topic in their quarterly report, and they gave a little bit of insight on how they're handling mortgage deferrals. Since many people have temporarily lost their jobs, they don't have the immediate means to continue paying for their mortgage, and to prevent a mass amount of defaults, most banks are offering mortgage deferrals to lighten the burden on the customer temporarily, and EQB is one of those banks. In the credit quality section of the Business Outlook in their most recent quarterly report, they mentioned that they are engaging in mortgage deferrals, and they say that they believe the longer-term impact will be positive. They also mention here that they are recording the interest on deferred payments in revenue as it accrues, like the rest of the industry, and the deferrals should have only a moderate impact on our corporate cash flows. So this is kind of interesting because they're still recording these revenues on their income statement, even though they're not actually getting the revenue right off the bat. So this could be a little bit misleading. The revenues haven't really dropped a lot, but those revenues are still including the money that they're not getting currently from these deferred payments. So the higher risk of these deferred payments could make the revenues look a lot worse down the road. When these people start to get towards the end of their deferral periods and they have to start paying back, if the default rate increases, we'll see revenues that are being recorded now disappear in the future. Now, at the beginning of their report, they mentioned that they had granted deferrals to 14,500 customers, which comprises about 18% of their loan portfolio. And this is about $81 million. So that's quite a substantial amount. It's really impossible to say how many of those will actually default on their loans in the end, but that's really the exposure that they're putting themselves into that slightly increased risk category of deferred loan payments. So that's something to keep in mind when looking at their revenue and how it's being affected by this economic situation that we're in. Another thing to note on their income statement is that their non-interest income is quite low. So obviously they don't charge any fees on EQ Bank. They don't offer credit cards and other things that most of the more established banks do offer. For example, like TD obviously has a deposit-taking bank, but they also have credit cards. They also have an insurance business. They also provide financial advice and other services like that. So they get a lot of revenue from things other than interest. Now, EQ Bank is a little bit different because almost their entire business is based on loans. So their non-interest income is very low. So what this means for the business itself is that it's very exposed to national interest rate fluctuations. So in a low interest rate environment like we're in right now, they're likely going to have a harder time keeping their interest revenues up compared to their interest expenses. And because of this, their earnings will likely fluctuate as interest rates increase and decrease a lot more than, say, the other big banks. Now, you could kind of look at this as a positive or a negative thing. If you look at the year-to-date market price of EQB, you'll notice that they've been hit pretty hard, especially from the peak to the trough. They've lost over 50% of their value. I believe that could partly be because they're much more exposed to interest rate fluctuations, and they're just generally, the drop in price has been a lot more substantial than other banks, such as Royal Bank or TD. EQB has dropped 50% from top to bottom, and since the beginning of the year it's down about 30 to 35%, whereas the other big banks are only down between 10 and 20% on the year. So that's another thing to keep in mind. If you are investing in this company, they don't have a hugely diverse source of revenue. So yeah, just looking at the income statement, it seems as though they don't really have a heavily diverse way of making money other than their loans that they have on book. So with that, I'm going to go into the balance sheet and see what kind of financial health they're in. So right off the bat, you can see that EQ has the large majority of their wealth in the form of retail and commercial loans. It looks like that's, sitting around 90% of their assets. So considering that is such a heavy part of their portfolio, we should really understand what these retail and commercial loans actually are. So to figure that out, I went into their most recent annual report where they describe these things in a little bit more detail. So looking into their retail lending business, they say here that this business consists of alternative single-family lending, prime single-family residential, and decumulation business. Prime lending just refers to high-quality borrowers that qualify for the prime lending rate, which is usually the lowest rate that you can get from these major lending institutions. Now, alternative lending is a little bit harder to describe than that. An easy term to use for alternative lending is B-class lending. It's not the people with the best quality, but it's not scraping the bottom of the pot, bad quality. It's really people who are really close to having A-class credit, but they're not quite there, and they need a little help with negotiating interest rates and mortgage terms. So I looked into this in a little bit, and apparently alternative lending is actually almost 50% of the mortgage environment right now, which is it's a pretty high rate compared to what I was expecting. So obviously there are still specific guidelines for how somebody can qualify for these loans, such as no borrower can get a loan more than 80% of the value of the collateral, meaning they need to bring at least a 20% down payment to be able to get a mortgage. The rates that these usually yield are a little bit higher than prime rates, but it doesn't seem like they're a lot higher. Usually it seems within about 1% of the prime rate. So although the credit quality is lower, these aren't necessarily people with terrible credit. Now they actually break down how much of their retail portfolio is alternative and prime lending, and alternative lending is actually close to double that of the prime lending. So considering retail lending is their largest asset on book and alternative lending is the largest asset in that portion of their business, that means alternative lending is actually their largest investment that they have. So this might be quite offsetting to many potential investors. However, if you look back at the history of EQB, back in 2008 and 2009, during the global subprime mortgage crisis, EQB was running the same business they are now, and on each of their annual reports, they experienced no decrease in earnings or shareholders' equity during that entire time frame, and their stock price took a huge hit, but their fundamentals actually remained quite strong during that time. And that says a little bit about how the business is with their risk management policies. So although this is a slightly higher risk portion of the business, they have shown that they do really understand the business that they're in. Now, this isn't to say that you should ignore the fact that they are primarily alternative lenders. It presents risks that are higher than the typical prime lenders, but since it is such a huge part of the real estate economy, like I said, it was almost 50% of the mortgage market right now. It seems that EQB really understands this place, and if you're looking to expose yourself to this area, EQB might be a good investment. Now, their commercial lending business is a little bit more straightforward. They break it down into conventional commercial loans, where these consist of construction, multi-unit residential properties, shopping plazas, offices, and stuff like that. And they also just required this company called Bennington, which is in equipment leasing business. So this is branching out from their normal mortgage business. And this is a pretty small portion of their business as of right now, but this will be something to kind of keep an eye on going forward as they grow this business. So that pretty much covers what their business is. And this is kind of something to be aware of. As going over that, it's very clear that they're almost 100% a lender of Canadian mortgages. It doesn't seem like there's any real business outside of the country, and it doesn't seem like they really provide loans for anything other than property. So if you're looking for a more established and diversified lending company, this is probably not the place to look. An investment in EQB will be an investment relying almost entirely on the health of the Canadian real estate economy. And so going back to their balance sheet, we can see, as pretty much any typical lending company, the spread between their assets and their liabilities is quite thin. This is entirely because of the fact that it's a bank, and banks are very highly leveraged businesses. They take other people's deposits and they use that money to lend out to other people. So very little of the money that they're actually using is actually theirs. And that's really why the liabilities are almost as high as the assets. So now that I've kind of gone through some of the financial statements and using those, I've been able to break down what the business is in general. I'm going to look a little bit closer at a few of the financial numbers that stand out to me and look at a few ratios to really try to judge how EQB is doing compared to the industry. So as I've said before, their earnings have dropped notably in the last quarter due to the large increase in provision for credit losses. However, looking back on several annual financial reports, I've recorded their earnings since 2006, which is the farthest year that I could find their annual reports for. They've actually grown their earnings every single year since 2006. And there were a couple of years where their growth was really low. However, every single year they were able to average about 10 to 30% earnings growth from year to year. This is including the subprime mortgage crisis that happened over a decade ago. And this is reflected in the equity change as well. They've been able to grow shareholders' equity quite consistently. Now, considering this fact, if you're looking at the PE ratio, you could approach it in a couple different ways, really depending on how you think the company will do in the future and how the economy will recover from what's happening. If your outlook is quite pessimistic and you don't think things will recover quickly, EQB will really be at the forefront of people not being able to pay their bills on time because they're so exposed to the mortgage industry. If you think their earnings aren't really going to recover anytime soon, you might judge their PE ratio more so on the most recent quarter. So if you do that, that PE ratio comes out to about 12. And that's on the high end of what banks have historically been trading at. I've seen between 10 and 12 PE ratio for most banks during the most recent good times. If you think their earnings are going to stay around where they are or even go down a little bit more in the medium to long term, then yes, it's priced very well right now. However, if you think the economy will recover in a reasonable amount of time based on their historical performance, you might expect EQ to recover their earnings relatively soon within the next year or two. And in that case, their PE ratio right now would be between 5 and 6, which is really low, especially compared to the rest of the industry right now and compared to what banks usually trade at during good times. Now, you also have to consider what we've kind of discussed so far, and that is EQ is a lot more susceptible to changes in interest rates. They're not very diversified. They don't have a lot of different sources of income, and they're very heavily exposed to the real estate market. So considering that, people do have a bit of a reason to be a little bit nervous holding on to this company at a time like this. But considering how well they've performed in the past, I am not really too concerned that they'll have a problem recovering from this. And I'll get a little bit more into that with a few more numbers and ratios that I'll point out. The next thing that really stands out to me is their efficiency ratio. Now, this caught my eye as it is quite low compared to the industry standard. And just to note, counterintuitively, the lower the efficiency ratio, the better. It's calculated using the expenses as the numerator and revenues as the denominator. So the lower the expenses and the higher the revenues, the lower the efficiency ratio. So this shows that with the money that they're spending, they're getting quite high revenues in return for that. The efficiency ratio is sitting around 40% right now, and this is compared to other big banks in the industry, which average around 60%. So it's quite a substantial difference that EQ has here. And I think this is heavily due to the fact that they rely on a branchless banking model, meaning that they can keep their employee count and building expenses really low while still being able to reach a large number of people. Another thing that illustrates their efficiency ratio that was just mind-blowing to me is this statement here that they have from their annual report back in December. It says, "We also have a very highly productive workforce. Our revenue per employee was $1.4 million in 2019, nearly 2.4 times above the Canadian banking average of $0.4 million per employee." This made me really kind of consider how much a company can profit off of their employees. This is a huge number. Now, of course, this is only their revenues, so they're not taking into account their expenses, but still, this is a really high number, especially considering it's so much higher than other banks in the industry. Now, another thing to consider here too is since EQB is relatively small compared to obviously the big 6 Canadian banks, they have access to special funding from the CMHC, which is called the CMB program. CMB stands for Canada Mortgage Bonds. This is a program funded by the CMHC, and the CMHC is the organization in Canada that regulates and insures the Canadian real estate market. And what it does is it supposedly gives them very cheap capital to work with to allow them to actually compete with the big banks. So since EQB is quite small, comparatively speaking, they're able to access these cheap funds from the CMHC so they can grow their business a little bit more effectively when trying to compete with the big banks of Canada. So as they grow, I'm not sure the terms behind this, but this 30% chunk of funding will likely have to be replaced with something else. And that's where EQ Bank deposits will probably start to really help out the business and make sure they continue to have funding for the business. So I'm going to touch a little bit more on the provision for credit losses. I talked about them before, but it's really an interesting scenario with EQB. Some investors would immediately turn away seeing their provision for credit losses, as it is much lower than the industry standard. The large Canadian banks hold between 1 and 2% of their loan book as PCL, whereas EQB is sitting on a small pile that currently amounts to 0.54% of their loan book. And this is actually way higher than it usually is. Before this quarter, it was sitting at 0.06%, and the previous year at this time, it was sitting at 0.16%. And I looked back at their reports from over the last decade. They have quite consistently had a very low provision for credit losses rate. So what that actually tells me is that considering they're able to sustain this so well, even through economic uncertainty and the mortgage crisis that they lived through over 10 years ago, this tells me that they have very good risk management process. As in any entire year that you look at, going back to 2006, they've not had a decrease in profit despite this low cushion for losses. So this is something to definitely look into further and really scrutinize their risk management process. And I won't do that in this analysis as it's definitely not my area of expertise, and I don't think I'd be able to give a lot of insight on it, but this is definitely something to keep in mind when investing in EQB. Now, looking at the book value of the company, it's interesting to note that the market is currently pricing EQB below its current book value by almost 10 to 15%. Now, this is likely due to the fact that investors in general are very pessimistic about borrowers being able to pay back their loans effectively. However, if you're optimistic about the economy's recovery, this could be a fantastic time to invest in a company like this, as the market is really nervous about this investment. Now, going into another financial ratio, capitalization is a really important metric to look at when analyzing bank companies. This essentially measures how well a lending company is able to withstand much worse economic conditions than they expected. This goes past the provision for credit loss rate. This is the amount of liquid capital that the bank holds to be able to cover losses that they weren't expecting in the first place. Now, regulations for this have gone up quite substantially, as this was really a big reason for the downfall of the banking industry back in 2008. Banks were just not capitalized properly, and they weren't able to sustain themselves in serious economic pressure. So regulators have increased this amount. I'm not sure what the minimum right now is, but I think it's between 4 and 6%. However, banks are highly encouraged to have at least 10% of their loan book in liquid capital. Now, looking at the other major banks of Canada, they usually sit between 10 and 12% capitalization. However, EQB is actually higher than the industry standard, which is sitting at about 13.5 to 14%, which means they're actually capable of withstanding a higher percentage of loan book loss than the other major banks of Canada, which is definitely reassuring. Now, finally, I'm going to touch on EQB's dividend situation and look a little bit at its history. I was recently reading Ben Graham's security analysis, and I was reading the dividend factor chapter in it. I found it quite interesting that he shows several case studies here when two very similar companies have very different dividend policies. The one who's paying a higher dividend and they're actually able to sustain it will typically be valued higher than the other, all else being relatively equal. Of course, this was written a long time ago, long before the internet revolution and everything that we've been experiencing over the past 20 years or so, but it holds an interesting point that I believe still holds some value today. Currently, EQB's payout ratio, which is the dividend divided by the earnings, so it's essentially how much of their earnings are they paying in dividends, and their payout ratio is about 25%. And based on the earnings of last quarter, when times were still good, its payout ratio was under 12%. This is quite conservative compared to the other big banks, where their payout ratio as of last year was about 50%, and now some of them with their lower earnings are close to even 100%. EQB has also been steadily increasing their dividends every single year for the last decade, so clearly their dividend payout is very sustainable. It is heavily covered by earnings. Also, as of their last annual report, they have laid out plans to increase their dividend by 20 to 25% per year over the next 5 years. Now, of course, this has been put on hold as Canada has strongly suggested that banks do not increase their dividends for the time being, considering the economic uncertainty. But I'm sure when things slowly get back to normal, they will try to resume this plan. So in this optimistic case, going back to Ben Graham's demonstration, since the dividend yield is really low right now, it's sitting at about 2%, people are probably not really buying this for their dividend payment that they're giving. However, when they do start to dramatically increase the dividend, it might catch more people's attention, and this could actually cause the valuation of EQB to go up as people start including it in their dividend portfolios. This leads to the idea that this company may be a fantastic dividend growth company right now because it is valued very low, and even though the dividend yield is quite low right now, someone willing to hold on to the stock for a long time could benefit very heavily from capital appreciation and eventually a higher dividend payout. So I've covered pretty much everything I wanted to. I'll give you a brief summary of the main takeaways from this analysis. So some of the really positive things that this company is showing is that they have a very high opportunity for deposit growth through EQB. I think they have a great product, and I will not be surprised if it grows substantially in the upcoming years. And with this being the case, this will provide them with a lot of funding to grow their loan book. They also have a very efficient model. They have low capital costs. They can keep their employee count low. They don't have to fund a bunch of branches for people to be able to walk into. However, since they're online, they have a very high reach, and anybody in Canada has the ability to go to them as a bank. They also have a very long-term history of health and sustainable growth. They were clearly able to sustain the subprime mortgage crisis, and they've been growing quite substantially over the past decade. They are also a very highly liquid business, which means even in times of unexpected economic activity, where there's lots of people who aren't able to pay back their loans, they have a lot of liquid capital where they're able to continue to cover their expenses through an extended period of time, and they probably won't have to declare bankruptcy as long as the recession lasts for a reasonable amount of time. Now, some of the other takeaways that could be good or could be bad depending on your investment strategy is EQ has a very low PCL, and to those who think about it optimistically, it's that since they've been able to maintain a low PCL for such a long period of time and through bad economic situations, they understand the business that they're in very well, and they have a good risk management process. However, for some of the investors that might look at it from a more conservative perspective, having a provision that's only 0.5% of your loan book is quite small, especially compared to the industry standard, and if somehow they make a mistake judging the level of risk of their loans, this could turn out to be a very bad thing for the company. Now, another thing to be aware of is that their biggest investment is alternative mortgages, and considering alternative mortgages are such a huge part of the market, somebody does need to cover them, and EQB seems to do a pretty good job of doing it. However, depending on your investment strategy, you might not want to be as exposed to that as EQB is, as it is highly dependent on how the economy is doing at any given point in time. Another thing that you might base your investment decision on is their currently low dividend rate. They have plans to raise it quite substantially in the future. However, those plans are put on hold for the time being, and we don't know when they will be put back into place. So if you're buying it entirely for the dividend, it's very low right now, and you'd have to just believe the fact that they're going to raise it in the future, and there's no guarantee that that will happen. And finally, there is a bit of a warning sign for the company. They are entirely dependent on the Canadian real estate economy, since almost their entire business is giving out mortgages to people across Canada. Now, this is great if you're looking for direct exposure to the mortgage market, and Equitable will probably fluctuate heavily with how people expect that market to be doing in the near future. If you're looking for a heavily diverse company, you'd probably be a lot more happy with the more established big banks of Canada rather than EQB, as EQB is a much more focused industry and they're a lot smaller, so they don't have a very diverse business, at least outside of the Canadian real estate market. So with that, my opinion, as you might have guessed with my positive demeanor towards the company in general, is that I think it will be a very good investment, especially considering it's trading at such a low valuation right now. I'm pretty optimistic that considering the technological state that we're in 2020, I believe people will be able to figure out a way to keep the economy going, regardless of whether we're able to be in close proximity with each other or not. Obviously, there has been and there will continue to be a lot of struggle, but considering they're focusing on growing their funds with EQ Bank so heavily, and the fact that they actually offer a very good product, I think there won't be a shortage of funds for the bank going forward, but it'll be very interesting to see over the next few quarters how EQB performs financially throughout the rest of 2020. I think considering the products that they offer, they have a high probability of gaining market share, especially from other banks. Like me, for example, I moved pretty much all of my money from CIBC to EQ simply because of the fact that EQ Bank provides a way better product. So if they're able to continue that going forward, I don't think they'll have a problem gaining market share over the coming years.
Thanks everyone for watching and making it to the end. If you feel like you got something out of the video, please hit the like button to help it reach more people. Also, if you want to see more financial videos from me, this is only my first video on the channel, but I plan to be making quite a few more in the future. So if that's something you'd be interested, stick around. This video is actually coming out the day before EQB is releasing their Q2 earnings for 2020. I'll be making another video about that, so check back here in a few days, maybe a week. There should be another video kind of going over how the company is doing so far throughout the year. Also, since this is my first video on the channel, I'd love to hear your thoughts. If you agree or disagree with anything that I said throughout the video, or if you have any questions or suggestions for future videos, please don't hesitate to comment down below. I'll definitely be looking at them and replying if I can. Otherwise, I hope you enjoyed, and I'll see you in the next video.